Good afternoon, ladies and gentlemen. On behalf of Christopher Winward, my partner, and Sean Gammon, our sales assistant, I'm Chris Swift, and thank you for taking the time to join us this afternoon, Swift Trading Company, to find out a little bit why we're turning bullish on the cattle market. So this afternoon, we're going to discuss a couple of things. First thing we're going to look at is why we think that we're having this turnabout to it. We'll go through a list of the different sectors of the industry to find out where the changes and shifts are taking place. And then we'll wrap it up with something that might be able to be beneficial to a trade or to a hedge or to help you to plan a little bit more into the future with that. So let's take a look at the very first thing. And it's a fundamental change of the industry. Going forward, we're going to have fewer cattle to deal with than we have in the last 6 to 7 years. We noted that the time frame between 2013 and 2016 saw explosive amounts of heifer retention and even cow retention to put that cow on life support so she could give birth to a calf. If the cow died during labor, it did not matter. She was giving birth to a cow that was worth 2 to 3 times more calf than what that cow was worth. So going forward, we believe that we have seen at least already a 1.5 to 2% decline in our herd from previous inventory reports. Now we come in here on this January inventory report, I think we'll be down a full 1.5 to 2%. A lot of that goes back to the 2017 timeframe where we had some significant weather out in the range areas. And then 2018 in the Nebraska area also hampered some of the beef production. As well, we've seen some packing increases. We've seen some capacity utilization increase significantly in the packing industry. Although we have no idea to know what increase the mom and pops have had on the industry, we do know that there is some small portion of them that has kind of helped take up some of the slack when we got into the real heavy animals this fall. But from the packing side, from the major fours, we know that greater robotics is being introduced into it, and as well as with more vaccines and more employment coming back online again, those labor pools for those packing plants will increase just a little bit too. So we know that we have stretched out somewhere between 675 and 680,000 head a week that we can kill. That seems to be ample with the amount of inventory that we've had on hand. Now going forward with lesser inventory to have to deal with, we're going to start seeing some of those packers probably have to go bid for inventory to bring them into their plant. So that's the biggest changes that we've seen, that we'll take this forward for 24 to 36 months, that we will see a lesser amount of production from the cattle side of it and probably stable to ever increasing slightly greater packing capacity simply due to the robotics and greater employment. So let's start with the center of the plate and the consumer having to deal with every kind of factor that we can ever imagine with this black swan of the COVID. Right now, we're looking at a large rate of increased spike. Most of the government officials are trying their best to either restrict businesses in some manner, to keep people separated and try to keep them safe. No doubt the government will continue to try to do those things because that's what government does. How can they protect the people? That's how they get elected the most. If they can come up with some way to protect everybody, there's a greater propensity for them to be reelected again. So I don't think that's going to go away anytime soon. The consumer, probably until we begin to see a turn in the rate of the COVID being taken by people, or not taken, but where the COVID is infected people, we see that turn. The virus will, the vaccine will probably help some of that as well. And we begin to see the consumer already, I believe, wanting to get back to what we perceived as normalcy prior to the COVID event. So I think there's a lot more business activity out there. I've seen prices rise on the retail side for just about everything. And although I understand a tremendous amount of that is for the COVID protection, as well as some of the distribution upsets that we've had from being able to get the product from either the service center all the way out to the brick and mortar store where it's going to be sold at, or even in the Amazon and some of the other delivery places, things are just a little bit slower. So from the consumer standpoint, I really have a difficult time seeing beyond the first quarter where they're going to be consistently impacted by this. The one thing that I will take away from all of this with the COVID is there is going to be much less likely a surprise to come about. The surprise was all at once. Hey, we've got a virus here that kills a lot of people and it's real serious. That was a huge shock. Going forward, we'll hear of now there's new strains of the virus. Maybe the vaccine didn't work as well, various different things that will happen, but very few of those will create shocks in the market, similarly to what happened there. So from the consumer, center of the plate, the shifts where we went from normalcy of hospitality and restaurants and grocery stores to just the grocery store will begin to slowly spread back out into some of that hospitality and restaurant business. So rising employment with a potential of further government stimulation, that's probably going to be a very interesting thing and may be coming sooner rather than later. I know that Congress is going to end at the end of this week. Maybe they come up with a stimulus package. There's several markets out there that are pointed in directions and have chart patterns that lead me to believe there's further upside movement to go. The desire of the public to resume life for pre-COVID level, increased patronage towards the hospitality and restaurant industries, and fewer government restrictions on business. So this covers the lower section, the center of the plate, where I believe all of this beef demand begins. So we go up to the grocery store and the restaurants. We know the restaurants right now continue to be restricted by the government. The restaurants that have been able to have the takeout orders have fared much better than the dine-in only. But we're getting into the time of the year, and there's a nor'easter coming in to New York right now in the in the northeast, that will really blanket that whole area. That's going to constrict business right there, pretty much down to restaurants anyway. So maybe that's not a bad thing. The weather will keep a lot more people inside. Maybe that begins to turn some of the infection rates down just a little bit. But for the next, more likely not, 2 to 3 months going into February and March, the grocery store will still be the main source where people buy their proteins, their meat proteins from. So if we believe that, we have to look at what the grocery store did during November, which was buy up a bunch of product, get it in the pipeline for the last weeks of December. Now here we are 1 week away from Christmas, and we're seeing the box price a little bit lower. We're seeing the fat price a little bit lower because the grocery store has now been able to fill the pipelines. And again, there's no greater surprise out there to the consumer that would cause them to rush in and do things. We noticed too that the consumer bought a lot of product in November and the 1st of December. They probably are sitting pretty good for right now and going to wait to see until after the 1st of the year. Do they need to restock? Are there going to be more restaurants open? Or is the grocery store still the place to do it? And the grocery stores having absolute instantaneous information from the consumer on how much product that they are buying, it makes them make decisions very quickly. So where they may have this product in the pipeline, they have it delivered sooner. We're already beginning to see a decline in meat quantity on there. Maybe the prices come up just a little bit, but whatever changes are probably still going to happen at the grocery store level more so than the restaurant. So from the grocery store restaurants, I anticipate another 2 to 3 months where the consumer will get the majority of their products still from the grocery store. So that's what we just got through discussing. I'm saying these before, and then we're putting up the visuals there of what that is. But grocery stores and discount bulk stores, Costco and Sam's Club, they've really taken a big chunk out of the restaurants. So as we see changes going forward, again, we're looking for more and more of that consumer to continue to eat at the grocery store, buy their product at the grocery store rather than the restaurants. So we go up the chain to the packers and the processors. And this is where I believe that the greatest amount of the shock came in. We all of a sudden had to close packing plants because of employees getting sick. And we didn't have the venues in line, or didn't have the resources in line to cover something like this. We'd never had a pandemic to wreak so much havoc. So packers now have learned. They have increased chain speed. So if we think about the very first, they separated people out on the line. They had fewer people employed there. They had less robotics. Fast forward to today, the robotics, although still may be months away from being implied, they had already been a part of the packing industry for a while, especially the poultry side. So I don't think it'll take very long to introduce those robotics. And we believe that the packers have plenty of money to expand in that particular side of the packing side so that they don't have to rely as greatly on the employment. The employment pools are very low. We know that in some cases, some people are working 2 jobs on 1 shift, or we're seeing somebody work 2 shifts. And that will soon go away because we've seen the unemployment rate drop. It's dropped consecutively every month. It will probably continue to drop regardless of whether there's a stimulus package or not. We are going to see more and more growth come in back into the economy again. And even if it never supersedes whatever the top of the economy may have been, just that growth factor will keep things moving at a pretty steady pace. So the Packers' ability to the Packers' ability to be able to process more cattle now with either greater robotics or a larger employment pool is going to have them be able to process more cattle. And now that we believe that there's going to be fewer cattle to process, those packers will eventually have to go bid up for inventory in order to make sure that that animal comes into their plant, so they will be able to process it and keep running at a higher capacity utilization. So capacity utilization of the packers perceived efficient, adequate, and potentially expanding lightly. Packing capacity contracted sharply from 2011 to 2016 as cattle production expanded in the same time frame. Current events led to greater automation in plants, as well as precautionary measures to enhance employee safety. The COVID-related issues will be anticipated to subside. The combination of increased robotics and fewer employee health issues should stabilize processing. So we keep all these things in print. We talk about them and keep them in print so that we can see in front of us and don't lose track of what's going on. So in the feed yard sector here, this is probably where it's going to start getting more margin away from the packer and sending that margin up through the rest of the production scale on it. Feed yards will have fewer cattle to deal with. They will be out there and they themselves will be searching because they will need to run at 100% as well. And that's where it's going to really start to get interesting. And as you can kind of see this bullish feeling starting to build with lower numbers out there and a belief that the consumer, although they may not rise rapidly in beef consumption, it's at a really hefty level right now and could grow even more. And if it were to go down, I'd probably say it would be a shorter time frame, maybe an event similar to this nor'easter that's coming in, or something else that may arise that impacts that consumer's discretionary spending over a shorter period of time. So the feed yards should be able to start seeing a little bit more of the margin that the packers have been able to hold because now they've got fewer cattle. They can hold on to those cattle, ask for a higher price for them, and then continue to move on and put that on through the chain up through the hourglass there. Commercial feed yard capacity remains elevated. However, supplies of cattle are believed declining due to the severe winters of 17 and 18. So I go back and I remember 2017 very well, and the ice storms and the numbers of deaths of cattle. And although it was hugely significant, there wasn't a great deal written about it because nobody really got out there and dug into it. Fast forward 2 years later to today, and we're starting to see, maybe we begin to see where we've already seen a slight decline in the herd. Maybe this January 31st report comes in with a little bit lower number because of some of those issues there. Probably most interesting there, and then the expansion of the cow herd from 2013 to 2016 is now getting very aged. So now we have to start wondering, what are producers going to do with those heifers? Over the last year, heifer slaughter the heifer placement has been approximately 40 to 37% of the mix. So we're believing that anything under 42, 41% is expansion. We're not seeing expansion. So potentially a lot of these older cows are dying and we're replacing them, keeping the heifer number low, but yet we're still killing enough cattle to bring the steer number down and some of the other, the bull numbers and the cow numbers down, and end up with a lower herd altogether. So with it currently, right now, from the they release that data quarterly, USDA does, on the mix of placements, heifer to steers. So the last one that I saw registered at 38%. It's very possible that were the drought to be broken sometime this spring, there'd be a desire to want to freshen the cow herd. You could move that down to 35%. So that means you just get more and more steers in there. You're pulling the heifers out, and that instantaneously makes for a lesser amount of inventory to go into the kill cycle. So that's something really important to watch as we go up the scale and we look at what the factors are for the cow-calf operator and what may cause them to make some of these decisions, either to A, as in the drought, continue to liquidate cows, or B, if it comes in and the drought breaks in the spring, we're able to see a little bit of refreshing of that herd and keep those heifers held back on the farm. So we go to the stockers and backgrounders now, kind of along the same lines as what the feed yard is. We should be able to see them participate better because we're going to see fewer calves coming in. And what do we get into? We get into a fight. And we get in a fight between the commercials and the private guys out there, and they both step into the same sale barn out there, and the commercial has been told, go buy me cattle. The private guys out there has got money in his pocket going, I'd like to buy me some cattle. And more likely than not, he'll be outbid every time by that commercial. Again, probably see further vertical integration within the industry, and that's going to make cattle be wrapped up tighter into vertically integrated supply chains that won't be very easy to break. So backgrounds are anticipated to begin wanting more heifer inventory, so they might be able to diversify. So just in my knowledge of talking with some of the producers out there that I do, that is an avenue that many of them look at. Instead of just buying steers, I'm going to buy heifers. In 3 months, when they get up to some kind of weight or age size to where they can be rebred, I take another look at the market out there, and I can say to myself, I can figure a break even on putting them on feed. I can figure a break even of having them bred and selling them as a bred heifer. Whichever one brings in the most dollars, that's the direction that I go. So I have to believe that at some point in time, this heifer market could get really good, especially if especially if the cow-calf operators begin to retain ownership of those the heifers that are theirs, or as well as we begin to see some backgrounders out there wanting to diversify just a little bit and see which is the better of the markets. So drought will be a very big key to that. As best I understand, there's not going to be much weather to break that drought until you get into March, April timeframe. When you get into the March, April timeframe, the weather will be able to look out and see whatever the changes in the normal ocean currents, ocean temperatures are then to see whether or not the El Nino either increases or decreases in severity, bringing moisture back into the Midwest again or keeping it dead dry. So let's look at those two factors. If we keep dry all summer long, things will stay slower. We won't get as bullish as fast because we're going to have to keep moving cow inventory into the kill mix. That would replace any decline in steer or heifer fed cattle that we might have seen where we've seen lower numbers come in. Well, unfortunately, now we got to kill more cows and we're still producing the same amount of beef. So a drought is going to slow things as far as a bullish factor goes. It will make it more bullish into the future because once you do get rain, then everything comes back and we're working from much lower levels. Then Australia is a great example right now. Australia fell right into the same things that we did in the 2012 and 2013 timeframes of the drought. They had to liquidate a lot of cows. Now they're in massive rebuilding of the herd. They are pulling a lot of inventory out of the kill mix, putting it back into the breed cycle again, and that has even dropped their exports tremendously because they're just not producing as much beef. Beef prices over there have risen significantly. So here in the U.S., we're fixing to follow along pretty much the same lines, depending upon the severity of the drought. If the drought does break and we do begin to see enough pasture regeneration to come back to where it'll hold the cows and the calves again, I would have a sneaky feeling that you will see a large movement of heifer inventory out of the kill mix and back into the breed cycle. So that's with the cow-calf industry, and they've got more problems. So this is literally the exact same slide as what I showed the last time, with land and water rights being right on the very forefront. In some of the meetings that I have attended, that is where all of the real excitement gets right there, either being angry or anything like that. We tend to see some things like that happening in the land and water rights. So if those continue, then it probably will make for lesser production. Urban encroachment that leads to greater interaction with the public. We've already seen lots of those incidents where you have a farm and you start getting the city limits to encroach on you, and the smells and the sights and the sounds aren't near as attractive as when I didn't live right next door to them. So we begin to see that being a big impact on production, on livestock production. So just know that those things are even more bullish in supply factors, because you'll have to most likely drop some of your land usage due to these factors on there that could be cattle production. Continual movement towards vertical integration as food service corporations grow. Food services will try to do multiple different things going forward to protect against this kind of thing happening again. Food service probably is going to need to come back up and get their pipelines filled very quickly. And I have a feeling that when they do, that will create another amount of demand onto the market that there has not been. It'll be commercial demand, not necessarily consumer demand. And then we see where the consumer gets that product from. But clearly right now, with the grocery store making up the majority of our area where we get it from, and the restaurant running second and third down, they'll come up as a very large competitor pretty soon. Competing meat proteins and alternative meat substitutes, veggie burgers, all that, they're here to stay. You can fight it, you can not like it, you can do whatever you want, but it's here to stay. Whether or not it ever makes an impact on it, it will be years before it ever does. The potential need to freshen the cow herd. I think that's really important, and that's something that I'm focusing on and watching the weather for, to see if we're going to see some kind of opportunity where we will be able to retain those heifers back and grow that cow herd just a little bit. And I'm not saying we're going to expansion. That's probably not what we're going to do. What we have done is killed a lot of cows, and we still have a lot of old cows out there. So I have a sneaky feeling that all you're really going to be doing is keeping that cow herd stable. And if we think about the amount of beef production that we've done, the amount of beef consumption over the years that has increased with our consumer discretionary spending habits increased as well, we can see easily where we could control a herd with this size, with the packing capacity that we have, keep the herd size right about here. There should be very few problems. We're not going to tax packing capacity any further. And that was the greatest leverage that the packer had. I don't care how many cows you need killed, I can only sell X amount of beef. So I always had too many cattle for the amount of beef that needed to be consumed or processed to be consumed. Now that's leveling off quite a bit. So we could see currently right now with a 38% mix of heifers into the placement, we could see that drop down to 35%, and that would make for a significant decrease in the amount of animals that we have on feed now. So we've been through the sectors, the center of the plate, the consumer. He's still got 2 or 3 more months of great government restrictions on them, either on their businesses or on their personal movement. The grocery store is more likely than not going to be our main source of meat purchases there. The packers have increased their packing capacity through greater robotics, and they will increase their employment pools going forward. This should help the backgrounders and the feed yards. There's fewer cattle out there to work with, should increase the margins for those cattle. And then the cow-calf operator being the very tail end of it there, how does he move with the drought? I think that we have seen significant calf movement in August and September that we would not have normally seen. Those cows are gone. I think that we've seen an elevated cow kill the last 6 to 7 weeks. I think that's drought related to a great extent. Now we come in and we go through the winter, which right now it doesn't seem to be too harsh on anything. As we move into the spring, it's 3 months away from now until we start seeing grass here in Tennessee. So once we start seeing that, and of course, we're not in a drought here, but as we move to the west, if we start to see that drought begin to fade a little bit, then again, we think the cow-calf operator is going to pull more of those heifers out of this mix, keep them back on the farm, and rebreed those cows. The only other thing that I can really think of that is of significance in all this is what our political outlook will be. And we understand that some of our senators are not as friendly towards commercial production of meats as others are. I don't really know that it's going to be any worse or any better, because I think it would be a year before anything would come about that's not COVID related. So most everybody is going to remain on this COVID train for at least another 3 to 4 months until something different changes in it. And then the political venue will change and they'll find something else to go after. Maybe meats and meat proteins will be one of those things they go after. But for the first 5 or 6 months, I think everybody's going to be so focused on the COVID. And if it does begin to subside, the reliefs that they have from that. So I'm going to open this up for questions now. That's all I've got for you this afternoon. Take that back. I'm not in. So I'm going to hang on just one second. I'm going to show you one slide of something here that's kind of important to me that I mentioned today. And go to this chart of feeder cattle, because I made this recommendation today, and I want to go over it with you for this reason. I'm sitting here talking bullish as can be about the cattle market, but right now, today, I'm not all that bullish. We got 2 more months to go through of the winter. We have lots of unknowns to it. And I'm at 11. I woke up yesterday going, the price of these feeder cattle are different than the last 5 years. They're here above 140 with the index still trading around 136 and change. And the ability to put on a fence hedge that gives opportunities $12 to $14 higher is right in line with what we've been doing for the last 4 to 5 years. So I see no real reason not to do it. And I can tell you that this year, the only difference would be the last 4 years we have appreciated greatly because the price has gone down. Every spring, the price has gone down for some reason. This year, the price may go up. And instead of benefiting from the futures markets going down, I may be benefiting from the cash market going up. So just take a look at this, and this gives you the parameters of it with a $3.35 premium, which is approximately what we closed at today, the spread between the 140 put, March put, and the 150 March call. So we expire on 3/31. You can see we closed at 140.77. The realized loss level, so we talk about the difference between unrealized losses and realized losses, and unrealized losses can materialize at any given time in the time frame of the trade. But realized losses only begin above the short call strike price. And if you do anything, and this is just my opinion alone, not to be confused with fact, but because convergence of basis causes more trouble to people than anything else out there, try to market your inventory as close to the expiration of a futures contract as you possibly can. And what you will allow to happen is the convergence of the basis. Right now, that futures market is $4 plus over the index. If within the next 6 weeks, you've got that trade on, and the price scheme, the basis is still the same, and you sell your cattle, you may or may not have incurred a loss in that position. And that loss may or may either grow or go back by expiration. But if it grows, that means your cash market is going up too, because in this case, the feeder cattle futures settles to the feeder cattle index. So we believe that the feeder cattle index is the most closely represented price of cattle in your area that there can be. Same basis to the indexes is to your area as it is to futures. But we know in order for you to begin to have realized losses at expiration of the futures contract and where you're hopefully selling your inventory, it's the least amount of premium that you will have to deal with, premium spread between the two that you'll have to deal with. So look at this, know that we've got a lot of troubles right here in front of us the next 2 to 3 months. consider whether or not you want to market this inventory now and then worry about what happens comes later under these fence protections here, or maybe just kind of ride it and see how long it doesn't go before it starts to turn. But I think this is an advantageous spot. Even if it goes $10 higher, I'm just now starting to get into a loss position, and I will have benefited over $13 from the rise of the index currently at 136 up to the 150 area. So I know that's a lot to go through today, and I know I've got through it pretty fast, but I'll open this up for questions. And then after the questions, know that you feel free to call me at any given time. We write a commentary every day, the Midday Cattle Comment. We put that out. Be glad to send you a trial for it for a little while. And if you like it, that's fine. If not, that's still fine. But just know that we put out information every day on this stuff. So I'm going to turn it over to questions here real quick and answer as many as I can. And then we'll proceed on from there.
Type it in the chat box.
Okay. Type it into the chat box. There should be a chat box somewhere about the middle of the screen there. And then you can click on that and you can type those messages on there, and we'll hang around here for a few minutes and see if we get any there. It looks like I've questioned y'all out. So
Oh, here we go.
There we go. So here's one coming up. All right. What do you believe the impact is of the 1,500 small butcher shops? It helped out the guys that had the 15, 16, and 1,700 pound steers that didn't get slaughtered. 2 went to, Uncle Jim and Aunt Frances's place, and 10 more of them went down the road to an old deer processing place, and none of it was sent out to the public. So I don't think that they had to be USDA inspected, because they were just being killed for themselves and then taken back home to the freezer. I doubt it's more than 1%. It may be. I don't know that there's any way to really get that number. But I know that there was a couple of places around town here that went from killing, 2 or 3 cows a week to 10 to 15 cows a week. So, it's 200 and 300% increases for them. But on the overall picture of things, I don't think it's that much. I think it was just enough to help out those that wanted to get some product killed faster.
We're going to mute people. Chris is doing mute people so they can ask questions.
Okay. So that seems to be about all the questions there. I won't keep up any more of your time. I know you're busy, and so I'd like to again extend anything that y'all need from us. Please feel free. We have recently moved and changed our clearing firms from RCG to ADM. We feel that we get a lot of good information from ADM, and anytime you'd like to know some of that, please feel free to call us, and we'll be glad to share with you what we can. So thank you very much on behalf of myself, Chris Windward, my partner, and Sean Gammon, our sales assistant. Thank you very much.